It's no exaggeration to say that over the past few years there has been a buzz about Angola. To outsiders, Angola seems to represent a perfect opportunity for investment. Political stability and almost a decade of solid growth has made it arguably one of the most promising destinations for investment in sub-Saharan Africa. Angola is the region's second largest crude oil exporter and has over the past 2 years periodically overtaken Nigeria for top position. It is also an important exporter of diamonds. But for those outside the oil and diamond sectors or the Portuguese-speaking world, Angola is almost unknown. And for first-time investors seeking to enter the market, the obstacles are daunting. So why the interest in Angola? Well, quite simply because of the country's enormous potential. Not only does Angola have a young and rapidly growing population, but it has vast untapped natural resources, including minerals such as iron ore and gold. There are also large tracts of unused fertile land and abundant water resources, ideal for agricultural development and biofuels. And most importantly, the country's location. Once rehabilitation of its rail and port infrastructure is completed, this could enable Angola to become a transport and services hub for Central Africa and the Gulf of Guinea. All of this potential will require new foreign partners to develop, and South Africa is perfectly positioned to play a key role in this. What I therefore propose to do with my presentation is set the scene for today's discussions. I will give the EIU's forecast of the political and economic scene and our own view on the key risks and issues facing investors in Angola's particularly difficult business environment. I will also look at who the main players are in Angola at the moment and the prospects for South African companies to greatly increase their presence there. So let's start by looking at the economy. Fueled by rising oil output and diamond output, real GDP grew by an annual average of 16.9% between 2004 and 2008, peaking at over 20% in 2007. Like South Africa, which remains the region's largest and most diversely based commodity exporter, Angola suffered badly during the economic downturn. Lower oil production, resulting from OPEC cuts and some technical problems, was compounded by the collapse in public investment, causing the economy to contract in 2009. Although I should point out that for political reasons, the government still insists the economy did not contract in 2009. However, the country is now leading the regional rebound, propelled by the recovery in oil production and the resumption of the government's ambitious program of infrastructure investment. Over the next 2 years, we expect Angolan growth to outpace its two regional rivals, South Africa and Nigeria. And notwithstanding slower growth in oil output, we still expect real GDP to average 7.4% per year in 2011 to 15. The source of Angola's growth is, unsurprisingly, crude oil production. This dominates the Angolan economy to an extent even greater than its oil-producing rival, Nigeria. The dominance of crude is particularly notable in Angola's export profile. Over the past decade, as you can see from this graph, the dominance of oil's contribution to total exports has risen from 87.9% in 2001 to 97% in 2010. If one includes diamonds and petroleum products, other exports account for just 0.6% of exports. This has made the government heavily dependent on oil revenues, which has periodically thrown its economic policy into chaos when international prices have fluctuated. Despite repeated pledges by the government to diversify the economy away from its dependence on oil, oil is set to continue dominating exports for the foreseeable future. The dominance of the oil sector is also reflected in the country's inflows of foreign direct investment, which are the highest in sub-Saharan Africa. According to data from UNCTAD, in the period from 2002 to 2010, Angola has received net inflows of FDI worth $81.4 billion. This is more than the total for South Africa and Nigeria combined. However, the size of these inflows is misleading, as the vast majority has been focused on the enclave oil sector, developing the country's costly but very rich ultra-deep offshore oil fields. Substantial inflows have also gone into developing infrastructure, which was wrecked by nearly 3 decades of civil war, much of it under Chinese-sponsored credit lines, about which I will talk later. But other more productive parts of the economy have been relatively starved of investment. The dominance of oil revenues and oil-related FDI has had a heavy impact on the government's economic policy. This is particularly apparent in the fiscal balance, which has fluctuated in line with the oil price. Rising output and high prices helped push the budget surplus to a peak of nearly 15% of GDP in 2006. But since then, a splurge in public spending has steadily eroded this surplus. The collapse of oil prices in late 2008, coupled with lower output, pushed the fiscal balance into an estimated deficit of over 8% of GDP in 2009. It has since recovered, but only weakly, and we expect modest public budget surpluses below 5% of GDP over the next 5 years. Large inflows of oil money have greatly hampered efforts to reform macroeconomic policy, and also they've impeded the improvement of public expenditure management. There have been attempts to improve transparency. The most notable include the regular publication of oil revenue flows and budget execution reports, as well as efforts to stamp out official corruption. But all too often, reforms have fallen by the wayside after coming into conflict with vested interests. As a result, Angola's economic policy management remains erratic, with periodic attempts to drive through reform losing steam in the face of rising oil revenues, only for a fresh crisis to drive the country into another round of reform. It is this history of wrenching change that has bred in the government a tendency towards gradualism, as they call it, instinctively rejecting major reform in favor of minor advances, which ultimately slows the reform process. Another problem has been the government's unwillingness to improve transparency in its fiscal accounts, and its tendency to either withhold data or to only partially release it. This was demonstrated in a very damaging way to Angolan interests in July this year, when the government let slip the level of its domestic debt arrears. A statement by the finance ministry first indicated that domestic arrears to construction companies had risen to $2 billion, a not inconsiderable sum for a medium-sized African economy. Then the Angolan president, José Eduardo dos Santos, stated in a press conference that arrears had risen to $6.8 billion. And the following day, the finance ministry issued a statement saying they could be as high as $9 billion, from $2 billion to $9 billion in less than a month. While running up substantial domestic debt is not unique in the global downturn, we only had to look at the PIGS, the UK, the US to see that many governments are running huge budget deficits. The manner in which the government handled the release of its debt arrears information with unclear and contradictory statements has been hugely damaging to investor confidence and has put paid to plans for Angola's first international bond issue for the foreseeable future. The dependence on oil flows has been particularly damaging to the government's exchange rate policy. Following the end of the civil war in 2002, the central bank adopted what was at the time called the hard Kwanza policy. This involved using the country's rising foreign exchange reserves to intervene in the currency markets and prop up the value of the Kwanza. This policy quickly succeeded in stabilizing the Kwanza's value against the US dollar, to which an unofficial peg was adopted, and the Kwanza remained at around 75 to the dollar from late 2007 until early 2009. This policy also helped keep a lid on inflation by reducing imported inflation, as Angola imports around 90% of its consumer goods. However, this was only sustainable in an environment of rising oil output, high international prices, and rising reserves. But in late 2008, the wheels came off this policy with disastrous consequences. As you can see from the graph, after peaking at over $20 billion in November 2008, FX reserves fell rapidly to a low of just over $12 billion in June 2009, prompting emergency measures by the central bank. These included tightening capital controls, severely restricting the sale of dollars within Angola, and the non-payment of domestic debt obligations, mostly to foreign construction companies. However, these were insufficient to stem the tide, and finally, after repeated claims that it would not devalue, in October 2009, the central bank loosened the peg with the dollar, allowing the Kwanza to depreciate to around 93 to the dollar by mid-2010. Since then, there has been a modest recovery in reserves, which topped around $17 billion at the end of September this year, and a stabilization of the Kwanza at around 92.5 to the dollar. However, the reserve position remains a major concern for us, and in the absence of better fiscal management, the risk of another forced devaluation is very high over the coming months.